Welcome back to Talk Tickers. Today we are stripping away the headlines and getting straight into the machinery of a regional bank that claimed to be hitting its absolute prime.
Right.
But if you looked at the market yesterday, it looked a lot less like a prime athlete and a lot more like a disaster zone. We are talking about Huntington Bank shares, ticker HBN.
It is a fascinating setup today. We have a classic case of what I like to call the boardroom versus the trading floor disconnect.
Exactly.
We're looking at the Q4 2025 earnings call, which dropped yesterday, January 23rd. And if you were sitting in that boardroom listening to the CEO, Steve Steiner, you heard words like flywheel, springboard, and momentum.
Oh, yeah.
He sounded like a man who just won the Super Bowl.
Right. He's painting this picture of a machine just firing on all cylinders. But if you're sitting at a trading desk or even just checking your app on your lunch break, you saw something very, very different.
Completely different.
The stock dropped about 6% to close at $17.64. But here is the stat that really jumped out at me. And I want to pause on this because it really sets the stage, the volume.
The volume, yeah.
We saw roughly 87 million shares change hands.
Which is massive. I mean, that is an enormous amount of paper moving around.
It's huge. Their average daily volume is usually around, 28 million?
Something like that, yeah.
So we are talking about triple the normal activity. This wasn't just a quiet earnings miss where people shrugged, sold a few lots, and moved on.
No, this was a loud rejection. Investors were essentially puking the stock.
Puking the stock. That's the right word for it.
It was a decisive reaction, absolutely. And it sets up the central mystery of this deep dive. You have a management team celebrating organic growth and record speed integrations. And you have a market that looked at the print and said, this is too expensive, it's too messy, and I want out right now.
So our mission today is to figure out who is right. Is this a buying opportunity into a flywheel of growth that the market is just too short-sighted to see? Or is the market correct to be terrified of the expense creep?
Let's get into it.
Let's start with the cold hard numbers.
Yeah.
What actually happened in the results snapshot to trigger that kind of sell-off?
Okay, let's rip the Band-Aid off. We have to look at the headline financials. GAAP EPS, that's earnings per share, came in at 0.30 cents.
Okay.
Adjusted EPS, which strips out some of the one-time noise like merger costs, was 0.37 cents.
And just to set the table, what was the street looking for? What was the expectations bar?
Consensus was hovering right around 40 cents.
40 cents.
So we are looking at a 3-cent miss on the adjusted number. Now, in a forgiving bull market, or if you're a tech stock growing at 50%, maybe you get a pass on a 3-cent miss.
Maybe.
But in this environment, for regional banks where every single penny is scrutinized, missing by 3 cents gets you taken out to the woodshed.
Okay, so they missed the bottom line. Investors hate that because it feels like money out of their pocket.
Mm-hmm.
But usually when you miss earnings, you look to the top line to see if the business is actually growing.
Right.
Are they bringing money in or is the business shrinking?
Actually, yes. This is where it gets interesting and where that disconnect starts. Revenue was $2.191 billion, which is up 11% year over year.
That's not bad at all.
And net interest income, or NII, was nearly $1.6 billion, up 14% year over year. So the engine is generating cash. That isn't broken. In fact, double-digit revenue growth for a regional bank is actually quite strong.
So wait, if revenue is up double digits, which is honestly pretty good for a bank of this size, why the earnings miss? It feels like if you make more money, you should keep more money. Where's the cash going?
And that brings us to the number that the bears, the pessimists, are staring at right now, the efficiency ratio.
Let's break that down for everyone because bank accounting can get a little dry.
Sure. Think of the efficiency ratio as just the cost of doing business. It measures how much it costs you to generate $1 of revenue. You want this number to be low.
The lower the better.
Right. In Q3, Huntington's ratio was 57.4%. In Q4, it spiked to 64.2%.
Ouch. So just to be crystal clear, for every single dollar of revenue they brought in during the fourth quarter, they spent roughly 64 cents just to keep the lights on, pay the staff, and run the systems.
Exactly.
That is a significant jump in the wrong direction.
It's a huge jump. In banking, the golden rule is you generally want that number under 60%. When it creeps up towards 65, it screams expensive. It suggests management might have lost discipline on costs or that the organization is just getting bloated.
And that's the story of the sell-off.
That is the crux of the sell-off. Management is calling this investing for growth and citing notable items related to acquisitions. The market, however, looks at that 64% and simply calls it expense creep.
Expense creep is the polite way of saying bloat. But let's unpack that because that is the strategic conflict here. We need to understand the why behind that expense spike.
Yeah.
Management was very vocal that this is about the noise versus the core. CFO Zach Wasserman and CEO Steve Steiner were practically pleading with analysts to look past $130 million in notable items.
Right. And to be fair to them, they aren't just lighting money on fire for fun. They have a lot going on. They are integrating two different banks essentially at the same time. You have the Veritex partnership, which they noted is already closed.
And they were bragging about the speed on that one, right? I saw a number in the transcript that seemed surprisingly specific.
They were very proud of this. Brant Standridge, the president of Consumer and Regional Banking, highlighted that they completed the Veritex systems integration in just 187 days.
187 days.
Completed January 19th.
Wow. For those who haven't worked in bank IT or M&A, that is a sprint. Moving customer accounts, checking routing numbers, merging the tech stack. Usually that takes a year, sometimes longer.
It is objectively fast. It implies a very capable operations team. And then they have Cadence coming up right behind it.
Right, the second deal, they're stacking them.
Correct. Cadence is expected to close on February 1st, which is just days away from when this call took place. So you have these massive one-time costs hitting the books to get these deals done. Legal fees, severance, tech migration costs, rebranding branches.
All that stuff adds up.
The argument from the C-suite is, look, these are temporary pains for long-term gains. We spend the money now, we get the efficiency later.
But the market hates a messy quarter.
The market loathes complexity. When an earnings release requires an investor to do mental math to figure out what the real earnings are, subtracting this acquisition cost, adding back that synergy, adjusting for tax implications.
Let's get it.
Usually, investors just shoot first and ask questions later. That is exactly what we saw with that volume spike. People didn't want to do the math. They just wanted to sell the risk.
It's the too hard pile. But let's play devil's advocate for a minute, though, because if we only look at the expenses, we might miss the vision.
True.
Let's look at the bull case, or what Steiner kept calling the flywheel. He used that word a lot. What does he actually mean by that in this context?
He did use it a lot, and the metaphor is important. A flywheel is heavy and hard to get moving, but once it spins, it carries its own momentum.
Right.
The idea is that their operating model drives growth, which allows them to reinvest, which builds a competitive advantage, which then drives more growth. It's a self-reinforcing cycle.
And the proof for that is where they're growing.
Exactly. According to them, the evidence is where they are growing.
They are getting out of the Rust Belt.
In a major way. Historically, Huntington is a Midwest bank. Ohio, Michigan, solid, dependable, but generally slower growth economies. They are aggressively shifting focus to the Sun Belt, specifically Texas and the Carolinas.
I caught a stat in there regarding the Carolinas that blew my mind. They said in 2026, they're planning to open a new branch in the Carolinas every 2 weeks.
Every 2 weeks. That is aggressive expansion. It shows they aren't just buying these other banks, Veritex and Cadence, to sit on them. They are using them as a beachhead.
A launch pad.
They are buying the infrastructure so they can flood the zone with new branches. And it's not just lending. They are pushing fee income hard.
This is the other part of the flywheel. It's not just about loans, it's about services. Payments, wealth management, capital markets.
Precisely. Banking is changing. You can't just make money on the spread between deposits and loans anymore. It's too competitive. You need fees. They added teams from TM Capital and Janney right at the end of 25. These are investment banking types, advisory folks.
So they want to be the bank that not only lends a company money to build a factory in Texas, but also helps them take the company public or sell it later.
Exactly that. They are projecting 13 to 16% fee revenue growth in 2026. That is the springboard they kept talking about. They believe they can cross-sell all these fancy capital market services to the new customers they are acquiring in Texas.
So if I summarize the bull case, we are building a massive machine that is going to print money in the South. So stop worrying about the integration bill we just paid.
That's the pitch. Ignore the bill. Look at the engine.
But there is another element here that I think got lost in the noise of the sell-off, and that's the balance sheet itself.
Yes.
We cover a lot of banks on this show, and usually when a stock drops 6%, it's because investors are terrified of bad loans. Commercial real estate, office towers that are empty. Was any of that in this report?
That is the fascinating divergence here. This was not a credit event. If you look at the credit quality, it's practically pristine. Net charge-offs, or NCOs, were only 0.24%.
Can you contextualize 0.24% for us? Is that good?
It's incredibly low. In a recessionary environment or even a soft landing scenario, you'd expect that to be creeping up toward 0.50% or higher. 0.24% means their borrowers are paying them back.
Okay.
And their net interest margin, the NAM, actually went up. It's at 3.15%, up 2 basis points quarter over quarter.
So while other regional banks are fighting for their lives because their deposit costs are soaring or their commercial real estate loans are going bad, Huntington is actually healthy.
Their core banking engine taking deposits and making loans is very healthy. They aren't bleeding from bad loans. They're bleeding because they are spending money.
An important distinction.
And that is a critical distinction for an investor. One is a solvency issue. We made bad bets. The other is a management discipline issue. We are spending too much to grow.
Okay, so the engine is good, the car is moving fast, but the gas mileage, the expenses, is horrifying the passengers. Let's talk about the guidance, because this is where the Q&A session on the call got a little spicy.
It did. There was a palpable tension. You had analysts like Erica Najarian from UBS and Ken Usdin from Autonomous really pressing them on the math.
Erica specifically seemed to be trying to reconcile the baseline expenses with the additions from Cadence. It felt like she was trying to solve a puzzle in real time, and the pieces weren't fitting.
Exactly. She was trying to get to the bottom of the run rate. What will this bank cost to run next year? And here is the shocker that spooked the algos. Management guided for core expenses to grow 10 to 11%. On top of that, they confirmed a $1.1 billion expense add coming from the Cadence deal.
$1.1 billion. That is a big number to digest.
It is a massive number. Now, Zach Wasserman, the CFO, kept reiterating that they will generate positive operating leverage. In plain English, it means revenue will grow faster than expenses. He's promising a gap of about 150 to 200 basis points. So if expenses grow 10%, revenue grows 12%.
Okay.
That sounds good on paper, but that requires you to trust the revenue growth. The expenses are guaranteed. We know the bills are coming. The revenue is just a projection.
And they made a promise about synergies cost savings to justify this, right?
Yes. This is the timeline everyone needs to mark on their calendars. They promise that the cost savings from Veritex will be fully in the run rate by Q2 of 2026.
Okay, Q2 for Veritex.
And the Cadence cost savings will hit the run rate in Q4 of 2026.
So it's a waiting game.
It is entirely a show me story. The stock is essentially in the penalty box until they prove those savings are real. The market is saying, we don't believe you until we see the efficiency ratio drop.
Let's pivot to the investor context. What does this mean for the sector and for the experienced investor listening right now? Because Huntington isn't a small bank. This is a bellwether for the regionals.
The signal here is that the market is currently hypersensitive to execution risk. Regional banks are guilty until proven innocent.
Right.
And Huntington just asked investors to trust a massive integration plan, integrating 2 banks in a single year while simultaneously missing their earnings estimate.
It's a big ask. It feels like asking for a raise the same day you showed up late to work.
That's a great way to put it. It's a huge ask. The valuation gap we are seeing, the stock trading down, is because the synergy realization is backloaded. It's all happening at the end of 2026.
So if I'm an investor, I'm looking at a bank with 0.24% charge-offs, expanding margins, but the stock is down because everyone is terrified that integration costs are going to turn into permanent expenses.
Precisely. They are worried the fat won't get trimmed, that they will inherit the costs of Cadence and Veritex, but fail to cut the redundant systems.
Let's map out the catalysts. If you are watching this stock, what are the dates you need to know?
February 1st, 2026, Cadence deal closes. That's step 1. Then you fast forward to the Q2 earnings call.
Q2 is key.
They absolutely must show the Veritex cost saves appearing in the numbers. If they miss that, or if the efficiency ratio creeps higher, the stock gets crushed again.
And then the big one is the end of the year.
Q4 2026. They need to show the Cadence saves and that flywheel of fee income actually spinning. Until those milestones are hit, the stock might just tread water.
It feels like a disconnect between a management team playing the long game building for the next decade and a market that can barely see past next Tuesday.
That is the regional bank trade in a nutshell right now. The market doesn't have the patience for springboards. They want cash flow today.
All right, speaking of trades and cash flow, we have arrived at everyone's favorite part of the deep dive.
The disclaimer part.
The part right after the disclaimer. This is not financial advice segment. We are not financial advisors. We do not know your portfolio. And this is strictly for entertainment purposes.
There it is.
But we like to pitch an outrageous but plausible trade idea based on the dislocation we just discussed. So imagine you are a hedge fund analyst pitching to the investment committee. You see the carnage on the screen. What is the play on HBN?
Okay, I call this trade the synergy sprinter. And I'm going to use a long calendar spread or a leap call structure here.
Okay, a leap. Lay that out for the listener who might not trade options.
A leap stands for long-term equity anticipation securities. Basically, it's an option to buy the stock way out in the future. Here is the thesis. The market is pricing in an integration disaster. They think the costs are going to spiral. But look at the facts. They finished the Veritex systems integration in 187 days.
Which, as we established, is incredibly fast.
Right, so management isn't incompetent. They are just expensive right now. So the play is to go long, deeply out of the money calls for January 2027.
January 2027. So you were skipping 2026 entirely.
Exactly. You bypass the messy Q1 and Q2 of 2026. You don't want to be involved when the noise is loudest and the efficiency ratio is still ugly. You are paying for the option to participate in what I call the golden quarter Q4 of 26.
That's when the magic happens.
That is when the Veritex saves are fully baked in, the Cadence saves hit the run rate, and those Texas and Carolina revenue synergies actually start showing up. We are betting that by Christmas 2026, the flywheel isn't just buzzing, it's printing money, and that efficiency ratio drops back under 60%.
So you buy the 2027 calls while they are cheap because everyone hates the stock today. You're basically renting the stock for the future at a discount.
Right. And if you want the hedge fund kicker, if you want to be really fancy, you pair this by shorting a clean but boring peer.
Okay.
Find a pure play Northeast regional bank with no growth, no Texas exposure, and short that against Huntington.
You're isolating the integration alpha.
Exactly. You are betting that the chaos of integration eventually creates a super regional powerhouse, while the boring bank just stays boring. You're hedging out the general market risk and betting specifically on Huntington fixing its problems.
I love it. High risk, though.
Extremely high risk, let's be clear. If they botch the Cadence tech stack migration mid-year, if the systems crash and customers can't access their money, this trade goes to zero.
Yeah, that's a wipeout.
You are betting entirely on Brant Standridge and his team executing a perfect integration.
But if they do, you caught the bottom of the panic.
That's the game.
All right, let's bring it home. We have covered a lot of ground. Huntington Bank shares delivered a decidedly noisy quarter.
Noisy is the polite word. It was a headline miss. Expenses are up, the efficiency ratio spiked to 64%, and the market punished the complexity with a 6% drop on massive volume.
But underneath the hood, the engine is running. Revenue is up 11%, NII is up 14%, and credit quality is outstanding at just 0.24% net charge-offs.
Management says they are building a springboard for the next decade, focusing on high-growth markets like Texas and the Carolinas. The market, however, treated this report like a stumbling block.
And the difference between a springboard and a stumbling block is simply execution over the next 6 months.
It's all about the execution. They have to prove the math works.
That is going to do it for this deep dive into HBN. Remember, Talk Tickers is for entertainment, not advice. Do your own research, check the filings, and we will see you on the next print.
Thanks for listening.